Last night, Elon Musk said something on Tesla's earnings call that should have every silver holder sitting up straight right now. Not because Tesla beat earnings. They did. 0.41 actual versus 0.30 expected, a 36.7% beat. Not because gross margins jumped from 16.3% to 21.1% in a single quarter. Those numbers are impressive, but that is not why we are here today. We are here because of what came after the beat. After the applause, after the strong numbers, Tesla quietly dropped a bomb. Capital expenditure for 2026 will be $5 billion above prior guidance. $5 billion extra, above what was already planned. And the stock, which had jumped 4% in after-hours trading on the earnings beat, gave back every single gain the moment that number hit. Wall Street punished Tesla for it. Silver holders should be celebrating it. Here's why. That $5 billion in extra capex is not going into car factories. It is going into Terafab, Tesla's artificial intelligence computing infrastructure project, 1 terawatt of AI compute capacity, a scale of computing infrastructure that has never existed in human history. And here is what the financial media conveniently forgot to mention while they were busy writing about the stock reversal. Every server rack in that facility requires silver-coated connectors. Every circuit board requires silver. Every thermal management system requires silver. We are not talking about grams. We are talking about an AI infrastructure project at a scale where the silver demand is measured in the hundreds of millions of ounces over its construction timeline. The market punished the stock. The physical silver market should be pricing this in right now. It is not. Silver is sitting at $77.70 this Thursday morning, April 23rd, 2026, down from $80 to $13 at the start of this week. That gap between what silver is priced at and what the actual demand picture looks like is exactly where opportunity lives. But let us zoom out from Tesla for a moment, because there are 5 other things happening simultaneously today that make this one of the most critical Thursdays silver has seen in months. At 8:30 a.m. Eastern this morning, initial jobless claims dropped. Last week came in at 207,000, below the 215,000 forecast. The labor market is holding. At 9:45 a.m. Eastern, the April flash PMI is releasing. This is the number that will tell us whether the U.S. economy is expanding or contracting right now in real time. In March, the composite PMI was revised down to 50.3, barely above stall speed. The services sector came in at 49.8. That is already in contraction territory. Services represent 77% of U.S. GDP. If April's red comes in below 50 again, that is 2 consecutive months of services contraction. That is stagflation officially confirmed by the data, not just by analysts. And stagflation, for anyone who needs a reminder, is the single most bullish macro environment that physical silver has ever performed in. It happened in the 1970s. It is happening again right now. Meanwhile, Freeport-McMoRan and Newmont are both reporting earnings today. These are not random corporate events. Freeport-McMoRan is one of the world's largest silver byproduct producers. Approximately 18 million ounces per year comes out of their copper operations. Their CEO, Kathleen Quirk, said in March that demand for metals tied to electrification and data centers remains resilient despite the Iran conflict. Today, we find out if that confidence has held through April's escalations. Newmont is the world's largest gold and silver mining company. Their all-in sustaining cost guidance today will tell us something critical. If energy costs from the Hormuz closure are pushing their production costs higher, that directly signals mine supply pressure. Higher production costs mean natural production floors get established. Miners do not produce below their cost base. If Newmont's silver AISC is rising toward $20 per ounce because oil is near $94 per barrel, that is a supply ceiling that the paper market has not priced in yet. Now here's what is happening in the Strait of Hormuz today. And I need you to pay close attention because the sequence of events over the last 48 hours is genuinely extraordinary. Tuesday night, Trump extended the ceasefire with Iran. Silver bounced 1.43% on Wednesday, recovering to $77.70 from $76.55. Markets exhaled. People started saying the worst was over. Then Iran attacked 3 commercial ships in the Strait of Hormuz, hours after the ceasefire extension. 3 ships, not U.S. ships, not Israeli ships, commercial vessels carrying cargo through the world's most critical oil choke point. The White House was asked directly whether this constituted a ceasefire violation. Press Secretary Leavitt said, quote, "No, because these were not U.S. ships. These were not Israeli ships." Read that again slowly. The official U.S. government position is that Iran can attack commercial shipping without triggering any response, which means every cargo vessel, every oil tanker, every container ship passing through the Strait of Hormuz right now is doing so without any guarantee of protection. Insurance costs on Hormuz-adjacent shipping are going vertical. and 20% of the world's oil supply flows through that strait every single day. This is not a ceasefire. This is a controlled conflict with undefined rules of engagement. And it is keeping oil prices elevated, which keeps inflation elevated, which keeps the Fed paralyzed, which keeps real interest rates near zero, which is the perfect environment for silver to reprice dramatically higher. Brent crude is sitting between $98 and $100 right now. Goldman Sachs has issued a forecast that Brent will remain $20 per barrel above pre-war levels permanently, even if Hormuz reopens, because the war has fundamentally changed the risk premium baked into global energy pricing. Here's the number that Treasury Secretary Scott Bessent dropped this week that nobody in silver analysis is connecting properly. He said, and I am quoting directly, "In a matter of days, Karg Island storage will be full and the fragile Iranian oil wells will be shut in. Karg Island is Iran's primary oil export terminal. When storage fills, wells physically cannot pump anymore. Iranian oil production shuts down. Global supply drops further. Brent breaks $100. U.S. April CPI, which is not released until mid-May, comes in above 4%. The Fed, which is already holding rates at 3.50 to 3.75% with a 99.5% probability of no change at the April 29-30 meeting, cannot cut. Cannot. The stagflation trap closes completely. And silver, which has already gained 131% year over year, sits at $77.70, while the inflation environment that drove it from $29 to $121 continues to accelerate. Let us talk about the number that should be making headlines everywhere but is not. China imported 206.76 tons of silver in January and February of 2026. That is the highest level in 8 years. 8 years of Chinese silver import history, and January-February 2026 is the peak. Simultaneously, China has restricted silver exports to only 44 authorized companies, an export licensing regime that went into effect on January 1st, 2026. They are buying at an 8-year record pace while making it structurally difficult for their refined silver to leave the country. China controls 60 to 70% of global silver refining capacity. They are the largest refiner on the planet, and they are keeping the metal. The Shanghai physical silver price this week is tracking around $90 per ounce. That is a $13 to $15 premium over COMEX spot. A 17 to 19% gap between what physical silver costs in Shanghai and what the paper price says it should cost in New York. That gap is not a market inefficiency. That gap is the physical market telling you something the paper market is refusing to admit. Here is the COMEX situation as of today, April 23rd, 2026. And I want to give you the exact numbers because they matter. COMEX registered silver, the metal that is actually available for physical delivery, stands at 76.88 million ounces. Open interest on May contracts represents 235.2 million ounces of paper claims. That is a 3.06 to 1 imbalance. For every ounce sitting in COMEX vaults available for delivery, there are 3 paper claims against it. May first notice day is 6 business days away. If you hold May silver futures and you want physical delivery, you have to begin that process now. If you do not want delivery, you must roll your contracts to July this week. The math on this is not complicated. 235 million ounces of paper claims against 76 million ounces of physical metal is a system that functions only as long as nobody asks for the metal. The coverage ratio is 13.4%. This is the 6th consecutive COMEX report below the 15% stress threshold. That is an unprecedented consecutive streak of physical stress. In January, 33.45 million ounces, 26% of total vault inventory, was withdrawn in a single week. If something similar to that happens in the next 6 business days, the COMEX registered silver inventory gets cut to levels that have not been seen in modern trading history. And here is the technical picture that makes this even more precise. Silver is sitting exactly at the 50-day exponential moving average at $78. That level is acting as resistance. Silver tried to break above it on Wednesday and failed. If silver cannot break $78 before May 1st notice day, the shorts are winning the suppression campaign. If it breaks above, the path to $82, $83 opens immediately. And above that, the next major resistance is $90 to $94. The 200-day moving average sits at $63. That is the structural bull floor tested and held on March 23rd. Silver is trading in the range between its structural floor at $63 and its resistance ceiling at $78. The COMEX clock is the most likely catalyst to break that range. Now step back and look at the ratio. Gold hit an all-time record high of $5,602.20 on January 28, 2026. Silver hit its all-time record of $121.67 on January 29th. At those simultaneous peaks, the gold to silver ratio was approximately 46 to 1. Today, gold is at 4,705 Islers to 4,150, and silver is at 77,070. The current ratio is 61 to 62 to 1. Silver is underperforming gold by every historical measure. At gold's all-time high of $5,600, with today's ratio of 62 to 1, silver would be priced at $90.35. At gold's all-time high with a historic ratio of 46 to 1 that it reached simultaneously with silver's own all-time high, silver would be at $121. We are at $77. The math is not subtle. There is one more thing I need to tell you about today that directly connects to the Fed situation and why it matters for silver more than most people realize. Jerome Powell's term as Federal Reserve Chairman expires on May 15th, 22 days from today. Kevin Warsh, Trump's nominee to replace him, is blocked in the Senate. His confirmation hearing was described as contentious. There's a DOJ investigation that has not been resolved. Former Treasury Secretary Yellen said publicly, "I really don't see the FOMC accepting this in the short run." The United States Federal Reserve will potentially be leaderless on May 15th. The FOMC meets in 6 days, April 29th and 30. The institution that sets the price of money for the global economy is heading into a period of confirmed leadership uncertainty during an active Middle Eastern war, with oil near $100, with CPI at 3.3% and climbing, with Q4 GDP at 0.5%, stagflation confirmed by every single data point, and with a COMEX delivery crisis building in real time. Silver has gained 131% year over year. It is still 36% below its all-time high. The 6-year cumulative supply deficit is 762 million ounces, equal to 1 full year of global mining output that is simply gone from the system. The 2026 deficit is projected at 46.3 million ounces, the 6th consecutive annual deficit, the first such streak in modern recorded history. The Terafab AI infrastructure that Elon Musk revealed last night is not a quarterly story. It is a decade-long silver demand story that Wall Street has not begun to price. The COMEX delivery clock is not a theoretical risk. It is a 6-business-day countdown with a 3-to-1 paper to physical imbalance. The Carg Island shutdown is days away by the Treasury Secretary's own words. The Fed is heading into a leadership vacuum. Silver at $77.70 on April 23rd, 2026 is not a number that reflects any of those realities. The gap between the price and the fundamentals is where the opportunity is, and that gap is closing, 1 business day at a time.